In an interconnected world, the rumble of conflict in one region can echo across global markets, sending shockwaves through stock exchanges, commodity prices, and currencies. Wars, geopolitical tensions, and regional skirmishes don't just make headlines. They influence the flow of capital, the price of oil, and the decisions of investors, governments, and corporations worldwide. Understanding how global conflicts shape financial markets and oil prices is essential to grasping the fragile balance of the modern economy. The most immediate impact of conflicts is market volatility. Investors react to uncertainty by reallocating assets, selling off risky investments, and flocking to safe havens such as gold, government bonds, or the U.S. dollar. Stock markets can plummet in response to escalating tensions, particularly in industries directly affected by conflict, such as defense, energy, and transportation. These reactions are often rapid and sometimes disproportionate, reflecting fear, speculation, and uncertainty more than fundamental economic changes. Oil markets are especially sensitive to global conflicts. Many conflicts occur in regions critical to oil production, transportation, or refining. Any threat to supply, whether from infrastructure damage, sanctions, or restricted access, can drive prices sharply higher. Traders price in risk premiums, anticipating potential shortages or disruptions. Even minor geopolitical incidents can trigger dramatic swings in oil futures, demonstrating how the perception of conflict can be as influential as actual supply constraints. Supply chain disruptions are another significant consequence. Conflicts can halt production, close ports, and interrupt transportation networks. Industries dependent on raw materials, energy, or components face delays and cost increases. The ripple effects reach far beyond the immediate region, impacting global production schedules, logistics, and ultimately consumer prices. These disruptions highlight the vulnerability of interconnected markets to geopolitical instability. Sanctions and trade restrictions amplify financial impacts. When countries involved in conflicts face sanctions, they may be cut off from global financial systems, reducing trade and investment flows. Companies doing business internationally may have to pivot or halt operations, affecting profits and stock valuations. Sanctions can also indirectly impact commodity markets, including oil, by restricting exports or altering supply chains. In this way, policy decisions triggered by conflicts play a critical role in shaping market dynamics. Investor behavior under conflict conditions often shifts towards safe haven assets. Gold, U.S. Treasury bonds, and certain currencies see increased demand as uncertainty grows. These flows can depress equities and increase bond prices, influencing interest rates and capital allocation worldwide. Similarly, emerging markets often experience capital flight during geopolitical crises, as investors seek stability in established financial systems. The movement of capital in response to conflict underscores the interconnectedness of modern markets. Energy companies and oil exporting nations are directly impacted. Conflicts in oil-rich regions can disrupt exploration, production, and exports, leading to shortages and price spikes. Major producers may adjust output to stabilize markets, while alternative energy strategies and strategic reserves become central to national planning. The volatility of oil prices during conflicts can affect everything from airline operations to transportation costs, illustrating how global instability translates into economic pressure for businesses and consumers alike. The financial sector is particularly sensitive to geopolitical risks. Banks, hedge funds, and investment firms monitor conflicts closely, adjusting portfolios and hedging positions to mitigate exposure. Derivatives, futures, and options markets play a crucial role in managing uncertainty, but they can also amplify price swings. The complexity of financial instruments means that conflict-driven market movements can cascade across asset classes, creating chain reactions that affect equities, commodities, and currencies simultaneously. Currency markets are influenced as well. Conflicts can trigger rapid depreciation or appreciation depending on investor perception, trade exposure, and central bank interventions. Countries near conflict zones often see their currencies weaken, while traditional reserve currencies, like the U.S. dollar and Swiss franc, typically strengthen. Exchange rate fluctuations can influence international trade, corporate earnings, and investment flows, creating another layer of financial impact tied to geopolitical instability. Central banks respond to conflicts strategically. They may adjust interest rates, provide liquidity, or intervene in foreign exchange markets to stabilize economies. For instance, during conflicts that threaten energy supplies, central banks in importing nations may implement policies to mitigate inflationary pressures. Conversely, countries benefiting from resource scarcity may see central banks adjusting policy to capitalize on economic windfalls. The interplay between central bank decisions and conflict-driven market dynamics adds complexity to global financial stability. Commodity diversification is a strategic response to conflict. Nations and corporations may seek alternative sources of oil, gas, or raw materials to mitigate risk. Strategic reserves, energy substitutes, and supply chain flexibility become critical in ensuring operational continuity. Markets, in turn, react to shifts in sourcing strategies, adjusting prices and investment allocations accordingly. The ability of global systems to adapt to supply shocks demonstrates resilience but also underscores sensitivity to geopolitical events. Insurance and risk management industries play a hidden but vital role. Coverage for shipping, energy infrastructure, and corporate operations often spikes during conflicts, reflecting increased risk premiums. Companies may alter contracts, secure alternative routes, or invest in protective measures, all of which influence costs and profitability. These adjustments, while less visible, ripple through financial and commodity markets, affecting pricing, investment, and risk assessment. Media coverage and public perception also drive market behavior. News of escalating tensions, military interventions, or political instability can trigger rapid investor responses. Markets are highly sensitive to information, and even unconfirmed reports can cause volatility. The psychological component of conflict underscores the importance of perception in financial decision-making, where fear, speculation, and anticipation often dictate market movements as much as objective economic data. Technology and cybersecurity are increasingly intertwined with geopolitical risks. Conflicts can involve cyber attacks on financial institutions, energy infrastructure, or trade networks. Disruptions in digital systems can create temporary market paralysis, affect trading platforms, or compromise data integrity. These risks are now factored into investment strategies, insurance premiums, and government policies, highlighting the evolving nature of conflicts' impact on financial markets. Global supply-demand dynamics in oil are particularly reactive. When conflict threatens production regions, traders anticipate reduced supply, driving spot prices higher. Conversely, if markets believe conflicts will resolve quickly or that alternative supply can compensate, price spikes may be muted. Geopolitical analysts, energy experts, and traders work together to interpret events, projecting their influence on global consumption, reserves, and pricing. The oil market is therefore a barometer of both physical risk and investor sentiment. Investor sentiment in equities is closely tied to conflict scenarios. Defense, aerospace, and energy companies often see stock gains during heightened tensions due to anticipated demand increases. Conversely, travel, tourism, and consumer discretionary sectors typically face pressure as uncertainty dampens spending. These sectoral shifts illustrate how conflicts reshape capital allocation, influencing which industries benefit and which are constrained, creating ripple effects across economies. Long-term economic consequences also emerge. Conflicts can deter investment, slow GDP growth, and reshape trade patterns. Nations involved may divert resources from development to defense, while global supply chains adjust to mitigate risk exposure. These adjustments have lasting implications, affecting employment, innovation, and market dynamics for years after conflicts subside. Financial markets, in turn, anticipate these long-term impacts, pricing them into asset valuations and shaping investor strategy. Geopolitical risk indices and market modeling have become critical tools for investors. By analyzing historical conflict data, energy dependency, and political stability, analysts can forecast potential market impacts. These models inform hedging strategies, asset allocation, and investment timing, helping financial actors navigate uncertainty. The sophistication of these predictive tools underscores how deeply global conflicts are embedded into modern financial planning and decision-making. The next time news of a geopolitical crisis breaks, remember, the ripples extend far beyond headlines. Stock markets swing, oil prices shift, currencies fluctuate, and industries reallocate resources, all because global conflicts remain one of the most powerful forces shaping financial reality. In a world of instant communication and interconnected economies, even distant conflicts can have immediate and lasting financial consequences.